Yeah, hi traders. It's a massive week of event risk and landmines which we need to navigate our trading portfolios through, whether we're looking at corporate earnings, whether we're looking at central bank meetings, tier one economic data, or whether we're looking at China's stimulus measures which are likely to be announced towards the back end of the week. It's all going off. I'll show you what's expected in the video. Yeah, morning traders. Look, a massive week ahead in terms of event risk and events that we need to navigate our portfolios through. Being able to understand the distribution of outcomes, the extent of the movement that could potentially play out as a result of what we're going to hear. And being able to understand, do we want to keep those exposures over the news, or do we want to tweak them in some capacities? That ability to manage risk is what keeps us in the game. So what are we watching this week? I think from an earnings perspective, we get 48% of the S&P market cap coming out of numbers this week. It is the marquee event in terms of earnings, the marquee week. 60% of the tech sector will report numbers here as well. So we're watching numbers from Meta, from Alphabet, from Microsoft, from Intel, McDonald's. These kind of names I think are very much worth watching. You've got the NASDAQ rebalancing taking place as well. So we are watching earnings very closely. We've obviously got earnings trickling in from Australia as well, where we see Rio Tinto reporting after market on Wednesday. And it's really when we look to CBA, who report on the 9th of August, where we see the meat of earnings really start to kick in. We've got earnings in the UK as well, and the FTSE was one of the better performing markets last week. In Japan, we're watching the Bank of Japan. Now, I know this is a bank that traditionally has surprised us before. We saw that obviously in January and we saw that in December. But I think Ueda in charge of the Bank of Japan is trying to win credibility for their forward guidance now. So we would be a little bit shocked if they overdid what we saw in the headlines on Friday, where the headlines from Reuters suggested they weren't in any kind of rush to be moving on YCC, whether that's moving the band from 50 basis points to 75 or even 1%, or even retargeting themselves to the 5-year duration part of the curve is something to be seen. But certainly if you looked at Japan swaps, 10-year swaps last week, they were down 11 basis points. We've seen 10-year JGBs into 45 basis points. And the yen, as you can see here, is one of the worst performers last week in G10 alongside the Kiwi dollar. So people have really ratcheted those expectations back for Bank of Japan movement on Friday. But if you look at implied vols, it's cost G10. It's really the yen pairs which are quite elevated. And therefore, people are saying if they're going to get a move over anything, it's probably the Bank of Japan meeting. Going to the US, we are watching some sort of tier 2 data points this week, but it's really the employee cost index that comes out, which I think is going to be a big one there. The market is looking for that to be pared back to 1.1%. We know the Fed look at this very, very closely. So again, we're looking at on the inflation and the wage side of things. But of course, it's the Fed meeting which gets all the highlights here. That comes out Thursday at 4 o'clock in the morning Eastern Standard Time, followed by Jay Powell's presser half an hour later. Now, if we look at rates pricing to see what's discounted, we can see 24 basis points being priced in for this meeting. So thoroughly priced in. I think they're going to come out, they're going to continue to be hawkish. I don't see any point in Jay Powell doing victory laps at the moment because their inflation numbers are trickling down in the right direction. But given the tightness of the labour market, given where absolute inflation is at the moment, I still think that they want to keep the pedal to the metal. But they will be data dependent. They will give a view that if data comes in and continues to soften, that they'll go on an extended pause. But I still think they'll maintain a sort of a hawkish outlook going forward, and we can see that with the market now pricing November at 5.41. So we're effectively pricing a 30% chance of a rate hike there, and it's going to be data dependent. So I think we are watching that core PCE number later in the week very, very closely indeed. I think you want to look at it on a month-on-month basis rather than the year-on-year. So we're taking those base effects out to an extent. I think very simplistically, if we work on it on a 2 decimal point basis, for the Fed to hike in July and then go on an extended pause, I think we need to see these CPI numbers and the PCE numbers at below 0.25 of 1%. So that rounds it down to 0.2. Anything above that, and we round it up to 0.3. And I think the market will look to trade that November pricing and push that up to about 40%, maybe even 50% going forward. But we are watching that on a month-on-month basis. That core PCE number later this week, very interesting indeed. We've got an ECB rates decision coming through, as we can see from European rates pricing at the moment. This is priced at 23 basis points for the hike, so this is thoroughly discounted as well. Where we go across the curve, we can go into the future and we can see that terminal pricing around 387. I think that feels about fair. I don't feel that there's a big trade in rates pricing. I think the market's got that on point. And again, this is another central bank like the Fed who are going to hike and then they're going to basically go on an extended pause, very much driven by the data coming forward. Now, in the session ahead, we are going to be watching the PMI numbers. I think they could be quite influential on that idea about data dependency. If we have a look at the services number, that's expected to come at 51.6. I think that could be quite influential on market pricing. And of course, we are watching rate spreads as well. If we've got that highs on euro dollar around the 24th of April, around 110.95, a breakthrough that level could really be quite interesting as well. Going to Australia, and you can see rates pricing. We've got 15 basis points of tights being priced in for the 1st of August meeting. Of course, this week it's really going to be down to the CPI number that comes out midweek. The market's expecting headline to come in at 1% quarter on quarter, 6.2%. On the year-on-year clip. But have a look at trim mean. That's expected to drop 60 basis points to 6% from 6.6%. Obviously, if we wear a 5 handle on that, that could be quite positive for Australian risk assets. You may see the Aussie dollar coming under a bit of selling pressure on the back of that as well. If we have a look at terminal pricing in Australia, you can see that around 4.48, so nearly 4.5% is the expected, mate. So we've got one more hike left in us, and then a 64% chance of a second hike by the end by February of next year. Going to the UK, I think the services PMI number is going to be the big one there. We're going to be seeing that as part of the composite numbers. Obviously, we're looking at UK rates and seeing 39 basis points being priced in for the 3rd of August. So we've got one hike there, or 25 basis points, and a 57% chance of a 50 basis point hike at that meeting as well. So I think the services number is going to be very interesting. We know that manufacturing's been quite weak in the UK, but it's really that service sector. If we to see that going into decline or slowing down faster pace, then I think that rates pricing will probably swing to a 25 basis points, and people will question that terminal price at 5.85 as well. So a big week. We've got earnings, we've got data, we've got central bank meetings, we've got the Politburo meeting coming through, and of course we've got month-end flows to continue as well. So you've seen the rates pricing. Let's see how it goes this week.